Welcome to Talk Tickers. You know, the deep dive designed to get you well informed and fast.
We take that mountain of data from a critical earnings call, we find the insights, and we really try to give you the full strategic picture.
And today, we are wrestling with an absolute tightened Deere & Company.
Specifically, their fourth quarter fiscal year 2025 results, and maybe more importantly, the massive forward outlook for FY26.
Yeah, and this deep dive is so necessary because this call was the definition of a mixed bag.
A split decision, really. Operationally, Deere showed a lot of strength. They even delivered a solid revenue beat.
But when management started talking about the forecast for next year,
the market just panicked. It was a classic case of future guidance completely overshadowing what was, pretty good current execution.
we saw the stock drop, about 5.7% right away?
Immediately, it forced a total reassessment of Deere's entire risk profile.
Okay, so we're dealing with great Q4 execution, meeting some really grim FY26 expectations. Let's start with the good news, the quarter that just wrapped.
So worldwide net sales and revenues came in at $12.394 billion.
Which is an impressive 11% increase year over year.
It is, and it sailed past what the consensus was expecting. A very powerful showing on the top line.
And the core business, equipment operations.
To hit $10.579 billion. That's a nearly 6% beat against what analysts had modeled. So they delivered the volume.
They delivered, but you can feel the butt coming.
Yeah, the profitability narrative was already turning a bit sour.
Tell us about the bottom line.
So net income for the quarter, it actually contracted by 14% year over year. It landed at $1.065 billion.
And the EPS?
GAAP EPS was $3.93. Depending on who you ask, that was basically an inline number.
Okay.
But the real context here is the full year. For all of fiscal 2025, Deere's net income fell by 29% from its peak in FY24.
So we were already in a tough cycle.
We were. But what the market heard from the FY26 guidance suggests that the cyclical trough, this bottom, is much deeper than anyone anticipated.
Okay, let's jump right into that forward look, because that is why we're talking about a big stock sell-off. What exactly did Deere guide for net income in FY26?
The range they gave was $4.0 billion to $4.75 billion.
Now that sounds like a big number in isolation, but context is everything here. Where was the street?
The street was sitting comfortably expecting something closer to 5.1 to maybe even $5.3 billion.
That's a huge gap. I mean, the miss there is equivalent to the entire annual income of a decent-sized S&P 500 company.
It's a huge psychological hit. And management pinned this massive revision on two really overriding macro forces that are squeezing their core profitability.
Okay, what's number one?
First, the big pain point is North American large ag. This is their bread and butter, their highest margin market.
Right.
Management is now projecting industry unit demand in this segment will fall another 15 to 20% in FY26.
Another 15 to 20% drop. That is just brutal.
It is. And this extends the slump. It's driven by lower crop prices, high interest rates, high input costs, all of it.
It's forcing farmers to hold off on those big-ticket tractor purchases.
Exactly. And that flows directly into Deere's Production and Precision Ag segment, or PMPA, where they forecast sales declining by 5% to 10% next year.
Okay, so that's the cyclical volume problem. But the second headwind, that was the one that really felt like a shock to the system, the tariffs.
Correct. This is a policy-driven cost, and it is just skyrocketing.
What were the numbers they gave?
Deere disclosed that their pre-tax tariff costs were roughly $600 million in FY25.
Okay.
And here's the punchline for FY26. That exposure is projected to double. It's going to reach an estimated $1.2 billion.
Wait, hold on. Doubling a policy-related cost to $1.2 billion in a single year while demand is falling.
Yeah.
That figure alone is almost a quarter of their projected net income. That is a truly strategic level of risk. Why is it doubling so dramatically right now?
Well, management explained that while they absorbed the $600 million in 2025, they're now seeing expiring exemptions and other changes in the trade landscape. That's just
a policy cliff, basically.
It's a policy cliff, and it accelerates these costs dramatically in 2026. They think it'll be an even run rate, about $300 million per quarter.
And can they offset that with pricing?
They expressed confidence in being price-cost positive for the full year, meaning their price hikes should offset their input costs. But that incremental $600 million hit from tariffs is a material headwind that is specifically crushing margins in that P&PA segment.
Let's zoom in on that margin compression.
Yeah.
The P&PA segment operating margin is forecasted down to a really tight 11% to 13% range.
It is.
That seems to imply that for every dollar of sales they lose in that segment, they're losing a staggering amount of profit.
You're picking up on the key technical detail the market really latched onto, the decremental margin.
Okay.
Analysts on the call confirmed with management that the implied decremental margin for that P&PA sales decline is around 60%.
60%.
Yeah.
Now, for those of us who don't spend all day in financial models, what does a 60% decremental margin actually mean?
Think of it this way. A normal, pretty healthy manufacturing business might have a decremental margin around, say, 30% or 40%.
Right.
A 60% decremental margin essentially means that for every single dollar in sales revenue they lose in that large ag segment, 60 cents of profit just vanishes.
That is just crippling. Why is it so high? Is it all just that $1.2 billion tariff bill?
It's a combination really of two forces. First, the direct tariff impact. That accounts for about 1.5 points of margin hit in P&PA alone.
Okay.
But second, and this is crucial to understanding Deere's global business, a negative geographic mix.
Meaning where they're selling makes a difference.
A huge difference. North America, large ag, is structurally their most profitable market in the world. So when sales plummet there by 15 or 20%, it creates this massive negative mix effect globally.
So even if other regions are doing okay.
Exactly. Even if a place like Brazil shows solid performance, the decline in the most profitable region just drags the entire global margin down.
So even if the tariffs vanish tomorrow, the fact that North America is falling so fast means their implied decremental margins would still be historically elevated just from that mix effect alone.
That's the dual challenge they face. It shows that even great structural improvements can buckle under such severe cyclical and policy headwinds.
Okay, let's pivot to management's defense. I mean, they're not just standing still. They are pushing a counter narrative of resilience and long-term improvement.
They are.
So what's the evidence that they're managing this downturn better than, say, the last big one in 2016?
Well, CEO John May was emphatic. He said FY25 represents the best results yet for this point in the cycle, and he pointed to their smart industrial strategy.
And the numbers back that up.
The evidence is pretty compelling. They're delivering operating margins right now that are about 450 basis points better than they achieved in the 2016 trough.
Even with the tariffs.
Even with this immense tariff burden, they're just structurally a leaner company now.
And a huge piece of that has to be inventory control. They can't afford to be stuck with expensive machinery no one's buying.
That is the core strategic action here. Management emphasized incredibly tight inventory management as their key counter-cyclical move.
And they had a specific data point on that, right?
A stunning one. New field inventory for their highest horsepower equipment, so 220 horsepower and above tractors, is now at its lowest unit level in over 17 years.
17 years. That speaks volumes about their discipline. They are clearly trying to avoid the painful inventory gluts of past cycles.
Precisely. They are deliberately running lean. They are planning a very, very lean production start for North American large ag in Q1 of FY26.
And that's a tactical move, I assume.
It is. It will cause their margins in Q1 to be extremely low. I mean, possibly down to the low single digits, but it's a strategic sacrifice.
It keeps them flexible.
It ensures they don't flood the market, and it keeps production flexible so they can ramp up quickly when those demand signals finally turn positive. They're putting inventory health above short-term margin numbers.
That's a powerful defense against the cycle. Now let's talk about the growth engines, because the company isn't all gloom and doom. Where is that diversification kicking in?
We have two areas showing really robust growth. First, small ag and turf.
So this is like residential mowers and tractors for smaller farms. Hey, livestock.
Exactly. Sales in that segment are expected to grow about 10% in FY26.
And what's driving that?
It's being supported by a modest recovery in the housing market, which helps turf equipment and supportive prices for beef and dairy, which gives those smaller farmers some capital to spend.
And the other, arguably bigger growth engine was construction and forestry. That segment seems totally decoupled from the farm economy.
C&F was the absolute standout in the fourth quarter. It delivered a huge 27% sales increase year over year.
27%.
And they expect that momentum to continue, projecting around 10% growth in FY26.
What's supporting that?
It's underpinned by some powerful macro drivers: strong construction backlogs, high employment, and continued momentum from U.S. government infrastructure spending.
Infrastructure spending is a great multi-year tailwind, but they cited something else, something much more specific that caught my eye.
The surging data center construction starts.
Right.
That is a massive high-growth area that requires heavy earth-moving equipment, and Deere is a prime supplier there. These secular drivers are providing that crucial counter-cyclical cash flow to help them weather the ag storm.
Okay, so beyond the segments, you have to spend time on the smart iron. The tech edge that Deere insists is the real long-term story.
They are moving far beyond being just a maker of yellow and green metal. They are leaning so heavily into their smart industrial journey.
And we're seeing real adoption.
The adoption metrics are accelerating dramatically. Just look at their See and Spray technology. It covered over 5 million acres in 2025.
And that's up from, what, 1 million the year before?
A huge jump from just 1 million acres in 2024.
And the return on investment for the farmer has to be compelling.
Absolutely. The tech is achieving an average herbicide savings of around 50%.
50%.
And management brought this to life with a story about a customer who saved over $20,000 in chemical costs in a single day.
Wow.
That's operational efficiency that directly hits the farmer's bottom line, which is so critical when farm fundamentals are otherwise weak.
That kind of number creates a long-term economic moat, regardless of the cycle. What about their broader digital ecosystem?
Still climbing. The John Deere Operations Center now covers over 500 million engaged acres globally. That's a 10% year-over-year increase.
And now they're moving to the next level, right? Autonomy.
Full autonomy. They are commencing orders for autonomous row crop tillage kits for spring delivery.
And that's a critical point for the informed learner. Autonomy isn't just about efficiency. It's a direct response to a massive industry problem.
It addresses the severe labor shortages that farmers face. Autonomy offers operational flexibility, lets them run equipment 24/7 without needing to find qualified operators.
So Deere is positioning their tech not just as an upgrade, but as a solution.
An essential solution to the labor and efficiency constraints that plague modern agriculture.
Okay, so we've outlined this massive tension. On one hand, you have undeniable, excellent progress on structural improvements, inventory control, tech differentiation.
Right.
And on the other hand, all of that is being completely overwhelmed by two huge immediate macro headwinds. The steep 15 to 20% decline in core large ag demand, and that doubling of the tariff bill to $1.2 billion.
The question for you, the investor, it really boils down to the cycle call.
What's management's take?
Their core message is one of clear conviction. 2026 will mark the definitive bottom of the large ag cycle. They point to stabilizing factors like record consumption of U.S. corn and soy, plus about $40 billion expected in U.S. government support payments.
So they believe the fundamentals are stabilizing and the cycle has run its course downward.
They do, but the market is voting with its feet. The sell-off and the fact that Deere has significantly lagged its industrial peers and the S&P 500 over the past year, that reflects deep skepticism.
Investors are signaling that the downturn may be longer and that the policy risk, the tariffs, it's just too large to ignore. But the company is financially robust, right? They delivered $5.1 billion in cash flow from equipment ops in FY25. They're maintaining that healthy dividend.
They are. And while they did pause buybacks in Q4 because of heightened market uncertainty, they expect to resume normal capital allocation in FY26.
So management is projecting confidence that their cash flow can weather this storm.
Exactly. And fund that long-term technology vision.
The ultimate trade-off, then, is confidence in technology versus the reality of cyclical and policy risk. And that brings us to the segment where we think about the possibilities hidden in the data.
And now for the required disclosure. This is not financial advice. We are not recommending you buy, sell, or hold any security.
We are simply providing high-level analysis and context from the earnings call to deepen your understanding of the issues facing the company.
Okay, so let's explore an outrageous but plausible trade idea based purely on this tension we've described.
Given the stock's big drop and the market's fixation on that $1.2 billion tariff risk, where is the asymmetric opportunity?
The outrageous but plausible thesis is this. The market has over-indexed to the pain from the tariffs. It's ignored the possibility that the sheer size of that hit creates political pressure that might force a policy change sooner than expected.
Or that management's pricing power and supply chain shifts just absorb the shock faster than models assume.
Exactly. You bet on the structural story surviving the external hit?
So the first leg of the trade is long DE stock, based on the tech and the inventory health. How do we hedge the immediate operational risk?
We fund it by focusing on the only robust short-term cash flow proxy, the long CNF segment growth narrative.
Right. Construction and forestry up 27%, guided for 10% growth, driven by those secular tailwinds like data centers and infrastructure.
That segment's stability acts as your cash flow anchor while ag finds its bottom.
And for the global hedge, we've got to neutralize that South American optimism.
That's the key. Deere's flat guide for South America is built on the potential for major interest rate cuts in Brazil, where rates are still very high.
That's a risk.
That embedded optimism is a risk if global inflation lingers. So the aggressive move is to hedge against the failure of that assumption. You take a short-dated put on the US dollar Brazilian real FX pair.
And the logic there.
If Brazilian rates don't fall, that flat guide becomes a negative one, and the FX hedge should provide protection, assuming the Brazilian real weakened under the pressure of high domestic rates.
That connects tariffs, North American cycles, and South American rate policy into one fascinating high-conviction view.
It uses the known resilience of construction to bet on the unknown inflection point of agriculture.
It leverages the asymmetry of the information from the call.
That's it.
And that's the perfect way to frame the challenge facing Deere. We've seen excellent operational execution and technological differentiation, things like see and spray and autonomy. But this progress is currently being overwhelmed by two massive, immediate macro headwinds. A sharp decline in North American large ag demand, projected down 15 to 20%, and the doubling of that tariff expense to $1.2 billion in FY26.
So the key question for you, the informed learner, is whether you believe management's deep conviction that 2026 marks the definitive bottom of the large ag cycle.
Or if the doubling tariff risk warrants continued skepticism, suggesting the cycle itself has fundamentally changed because of these political costs.
It's the ultimate trade-off between structural progress and external policy headwinds.
Thank you for joining us for this deep dive. We look forward to continuing this analysis with you in the future.